The data we just pulled from the CME servers is not a statistical anomaly. It is a historical rupture. What we are witnessing is not a fluctuation in demand or a technical irregularity. It is a physical event that fundamentally alters the structure of the silver market. For the last 48 hours, we warned that China's export restrictions would fracture the supply chain. We warned that the banks were trapped. We warned that the physical market was separating from the paper market. What happened today at 2:30 p.m. Eastern Time confirms every one of those warnings and pushes the situation beyond precedent. Today, Friday, January 2nd, the CME issued 1,168 delivery notices. That represents 5.84 million ounces of physical silver demanded in a single session. But the real shock appears when we widen the lens. To understand the scale, the global mining industry produces roughly 800 million ounces of silver per year. That means before most market participants had even returned from holiday break, nearly 2% of the entire annual global supply was demanded through a single exchange window. This is not industrial hedging. This is not a manufacturer placing routine orders. No factory places a 17 million ounce order on a Friday afternoon. This is a coordinated physical grab. This is a run on the vault. The timing is critical. This did not happen randomly. January the 2nd is the first trading day after China's export controls went live. The China wall is no longer theoretical. The eastern supply pipeline has been shut. Every major institution in New York understands what that means. They know the roughly 39 million ounces sitting in COMEX registered vaults represent the last easily accessible silver on the planet. They also know that once those ounces are gone, price discovery collapses into no offer territory. So they did not hesitate. They did not scale in. They smashed the buy button and demanded delivery immediately. At the current pace, the math is brutal. Nearly half of the available registered inventory was stripped in 2 days. If pressure continues, even at a reduced rate, the exchange cannot survive another week. This is not trading. It is liquidation disguised as settlement. And the most disturbing signal is not just volume. It is intent. In 1980, when similar volumes appeared, it was the Hunt brothers attempting to corner the market. Today, it is not outsiders. It is the banks themselves. What we are witnessing is cannibalization. The suppression cartel has fractured. The long-standing truce between bullion banks is over. They are no longer cooperating to manage price. They are competing for survival. When you analyze the issuer and stopper data, the pattern is unmistakable. This was not metal shuffled between friendly counterparties. The metal moved in a straight line, out of one vault and into another institution's control. Usually, banks pass silver back and forth to keep the system liquid without removing inventory. Bank A issues to Bank B issues to Bank C, and the bars never leave the vault. That is how the illusion survives. But today, the loop broke. One major institution was forced to disgorge millions of ounces it could not afford to lose. Another major institution, formerly an ally, absorbed the metal without hesitation. This is what happens when confidence in paper collapses. Participants stop cooperating and start hoarding. This is the return of the ghost of 1980, but in a more dangerous form. Back then, the threat came from outside speculators. Today, the threat is internal. The institutions that built the paper short structure are now racing to dismantle it from the inside. They are switching sides in real time. And while this battle plays out at the wholesale level, the consequences for everyone else are immediate. As the banks feast on each other's inventory, the retail market is being starved. The supply chain for the public has moved from tight to broken. The raid on the exchange triggered an instant blackout across major bullion dealers. Shelves emptied, buy buttons vanished. Notify Me replaced pricing. This is not a coincidence, it is sequence. First, the banks drain the exchange. Then the mints lose access to industrial bars. Then dealers lose inventory. Then premiums explode. This chain reaction is now fully visible. The physical market is no longer responding to charts. It is responding to scarcity. The delivery spike is the opening act. It is the signal flare. It tells us that the entities with the best information, the earliest access to inventory data, and the deepest pockets have decided that paper exposure is no longer safe. They are converting currency into metal at speed. That decision alone tells you everything you need to know about what comes next. This is no longer about speculation or price targets. It is about access. And access is disappearing. While the banks were ripping millions of ounces out of the COMEX vaults, the retail market collapsed in real time. What we feared would happen weeks from now happened in hours. The supply chain that feeds the public did not bend. It snapped. This is the second phase of every physical crisis. Wholesale hoarding followed by retail blackout. And tonight, that blackout is total. I have been monitoring the inventory feeds of the largest bullion dealers since the market closed. The data is unambiguous. SD Bullion, one of the highest volume dealers in the United States, is officially out of current year American Silver Eagles. Not delayed, not low stock, out of stock. Even more alarming, their restock estimate is no longer measured in weeks. It now reads March. That is an 8-week supply gap at the beginning of January. That tells you everything you need to know about upstream availability. The U.S. Mint cannot source silver blanks, not because demand spiked overnight, but because the industrial bars that feed the mint were just absorbed by the banks. Kitco presents an even starker signal. Their Silver Eagle page does not display a price. It displays unavailable. No back orders, no reservations, no deposits accepted. Dealers love back orders because they are interest-free financing. When a dealer refuses to take your money, it means they are terrified they cannot replace inventory at any price. That is not a sales decision. It is a risk decision. Then there is APMEX, the dealer of last resort. They always have metal because they charge the highest premiums. If APMEX runs dry, the retail market is finished. Right now, they still have some inventory, but the price tells the story. A single random year American Silver Eagle is listed at roughly $89. The COMEX spot price is $71. That is an $18 premium. A 25% surcharge just to touch the metal. New mint condition coins are pushing $95. This is not retail greed. This is replacement cost panic. This is the bifurcation in its raw form. JP Morgan pays $71 per ounce because they buy millions of ounces in one transaction. You pay $90 because you buy 1 ounce at the end of a broken supply chain. The discount has been fenced off for institutions. The premium has been passed down as a retail tax. And this premium explosion is not limited to government coins. Generic rounds, once the affordable option, have jumped from $2 over spot to $8 over spot almost overnight. Even pre-1964 junk silver, historically ignored, is now trading at premiums approaching 40% over melt value. There is no cheap silver left. The paper chart may fluctuate, but the physical market has moved to rationing. This is why waiting for a dip is now a structural mistake. The paper price can be smashed to 65 tomorrow by algorithmic games. That does not create inventory. You cannot buy what does not exist. When supply is gone, price becomes irrelevant. Availability becomes the only metric that matters. And the silver did not disappear. It moved. It moved from the available pile to the unavailable pile. To understand how severe this is, we have to follow the inventory trail into the vaults themselves. The end-of-day COMEX clearing report confirms the damage. Registered silver, the metal actually available to settle delivery, has collapsed to approximately 39.4 million ounces. In the last 24 hours alone, registered inventory dropped by roughly 2.8 million ounces. Now connect the dots. One major bank delivered over 3 million ounces. Another absorbed more than 4 million. Yet registered inventory fell by nearly 3 million. That tells us the metal did not simply change ownership and stay liquid. It was removed from circulation. It was either reclassified as eligible, meaning not for sale, or physically withdrawn. Those ounces will never be sold at $71 again. At the current burn rate, the math becomes terrifying. We just witnessed 17 million ounces demanded in 48 hours. With less than 40 million ounces remaining in registered form, the exchange has roughly 2 to 3 days of inventory at that pace. This is not a theoretical stress test. This is real-time depletion. And the crisis is not confined to New York. The Shanghai Futures Exchange reopened today after the holiday, and the response was immediate. Inventory dropped by 46 metric tons in a single session. That is roughly 1.5 million ounces consumed domestically on day 1 of the export ban. China is not exporting silver. China is hoarding it. Domestic industrial buyers are vacuuming their own exchange because they know the gate is closed. Put the numbers together. New York bleeding nearly 3 million ounces per day. Shanghai bleeding 1.5 million ounces per day. Global visible inventory is shrinking by roughly 4.5 million ounces every single day. Mines produce only about 2 million ounces per day. The system is running a structural daily deficit of over 2 million ounces. There is no buffer. There is no hidden reserve. The arithmetic no longer balances. This is why the banks move first. They saw these numbers before anyone else. They understood that dollars are infinite, but silver is not. They chose to convert paper into metal while it was still possible. And in doing so, they detonated the retail market. This is no longer a speculative squeeze. It is a resource lockout. The shelves are empty because the vaults are emptying. And the speed of this drain tells us we are not approaching the event. We are inside it. Now we reach the final question, flooding every serious desk and inbox. Did this break the banks? Is JP Morgan insolvent? Did the raid expose a financial collapse? This is where most observers make a fatal analytical error. They confuse a liquidity crisis with a resource crisis. We need to strip emotion away and look at the balance sheet math with discipline. JP Morgan and Citigroup combined took delivery of approximately 4.42 million ounces of silver in a single session. At a spot price near $71, the total cash cost of that operation was roughly $314 million. To an individual, that number is staggering. To a global, systemically important bank, it is trivial. JP Morgan holds over $1.6 trillion in Tier 1 capital. Citigroup holds roughly $240 billion. $300 million represents roughly 0.02% of their combined safety buffer. This transaction does not threaten solvency. It does not trigger margin calls. It does not stress capital ratios. Anyone waiting for JP to fail because of this purchase misunderstands the battlefield. The banks will never run out of dollars. They have unlimited access to liquidity. They sit at the top of the monetary pyramid. The Federal Reserve stands behind them with an infinite balance sheet. There is no dollar squeeze. That narrative is a distraction. But here's the pivot, and it is the most important insight of this entire event. While the financial cost of the raid was negligible, the physical signal is deafening. If $300 million is pocket change, why did they do it? Why did they break the unspoken truce with Deutsche Bank? Why did they drain registered inventory to critically low levels? Why did they risk triggering a retail panic? The answer is simple. They are not afraid of losing dollars. They are afraid of losing access to metal. This event proves the crisis is not about solvency. It is about availability. The banks understand that while fiat currency can be created instantly, physical silver cannot. They know that the same $300 million spent today buys 4 million ounces. Next week, it may buy 2 million. Next month, it may buy nothing. So they moved first. They front-ran the revaluation. This is not dumb money getting squeezed. This is ruthless money doing the squeezing. The banks are no longer defending paper shorts. They are abandoning them. They are flipping from suppressors to accumulators. They are cannibalizing weaker institutions. Deutsche Bank was not unlucky. It was exposed. This reframes the entire market. We are no longer in a classic short squeeze where retail hopes price rises to punish banks. The banks have already hedged. They have already switched sides. They are now long physical silver. The war is no longer public versus Wall Street. It is Wall Street versus itself. Strong balance sheets versus weak ones. Access versus exclusion. And this has consequences for everyone else. When the largest financial institutions decide availability matters more than price, price becomes meaningless. The $71 spot quote is no longer a market signal. It is a screen artifact, a distraction tool. While the ticker prints 71, inventory prints critical. While the ticker prints 71, retail shelves print sold out. While the ticker prints 71, Shanghai vaults print minus 46 tons. This is the hallmark of terminal bifurcation. The paper market continues trading because it must. The physical market stops functioning normally because it cannot. When these two diverge far enough, the paper price loses authority. The real price becomes whatever clears the next available ounce. This is why the events of the first 48 hours of 2026 matter. We saw a 17 million ounce delivery spike, the largest in nearly half a century. We saw a major bullion bank effectively liquidated. We saw retail supply chains shut down. We saw registered inventory collapse. And we saw China's domestic market begin consuming its own reserves immediately after the export ban. These are not independent signals. They are one system failing in sequence. The final illusion to destroy is the idea that waiting is safe. Many are watching charts, hoping for a dip. That logic belongs to a functioning market. This is no longer one. You cannot buy metal that is not offered. If price dips while inventory is gone, you gain nothing. By the time price reflects reality, access will already be lost. This is why the banks moved with urgency. They are not trading for profit. They are securing survival. They are converting paper claims into tangible assets before the window closes. They are gathering chips before the lights go out. So here is the bottom line of the first 2 days of 2026. The suppression regime has fractured. The physical market has taken control. The retail window is closing, and the largest players have made their choice clear. Possession matters, paper does not. This is not hysteria, it is arithmetic. The mines cannot keep up, the vaults are draining, the export gates are closing, the banks are hoarding, the price mechanism is failing. Do not watch the chart. Watch the inventory. Do not listen to commentary. Watch delivery notices. The war has already begun, and the first shots were not fired by retail speculators. They were fired by the banks themselves. Hold what you can secure. Understand what you are witnessing. History is not coming. It is already here.